Accounting is often seen as a daunting subject, but it's really just a way to track money, your money. At its core, accounting revolves around the basic equation: assets touch liabilities plus equity. This means everything you own, assets, is funded either by what you owe, liabilities, or your own investment, equity. Let's break it down. Think of assets as your cash, equipment, and inventory. Liabilities are your debts, like loans or unpaid bills. Equity is what's left over after you subtract your liabilities from your assets. Now consider the accounting cycle. It starts with recording transactions in journals, then posting them to ledgers, and finally preparing financial statements. These statements, like the balance sheet and income statement, give you a snapshot of your financial health. Accounting is the systematic process of recording, measuring, analyzing, and communicating financial information about an entity to stakeholders such as management, investors, regulators, and the public. It serves as the foundation for financial reporting, enabling informed decision making and ensuring accountability. The primary purpose of accounting is to provide timely and relevant financial information that helps in monitoring an organization's performance and financial position. Accounting principles are the rules and guidelines that govern how financial statements are prepared and presented. Key accounting principles include the historical cost principle, which states that assets should be recorded at their purchase price at the time of acquisition; the revenue recognition principle, which indicates that revenue should be recognized when it is earned, regardless of when cash is received; the matching principle, which requires expenses to be matched with the revenues they help to generate in the same period; the full disclosure principle, which mandates that financial statements should provide all necessary information to ensure that users can make informed decisions; and the conservatism principle, which advises that when faced with uncertainty, accountants should choose methods that minimize the overstatement of income or assets. The basic assumptions of accounting provide the framework that underpins the accounting principles. They include the economic entity assumption, which states that the financial activities of a business are separate from those of its owners or other businesses; the monetary unit assumption, which asserts that only transactions that can be expressed in monetary terms are recorded; the time period assumption, which divides the life cycle of a business into time periods for reporting purposes; and the going concern assumption, which assumes that a business will continue to operate indefinitely unless there is evidence to the contrary. While the basic principles of accounting provide a framework, certain circumstances may require modifications. These modifications help ensure that financial statements present a fair view of financial performance and position. Examples include the materiality principle, which aims to prioritize relevance and simplicity in financial reporting, allowing minor discrepancies to not follow strict principles if they do not materially affect the decision-making of stakeholders; and industry practices, where specific industries may adopt conventions and practices that deviate slightly from standard accounting principles to better reflect their specific operations. The double entry system is a foundational accounting principle that ensures the accounting equation assets shares liabilities plus equity is always in balance. It requires that every financial transaction affects at least two accounts in the following way: debits and credits, where each transaction is recorded as a debit in one account and a credit in another, ensuring that total debits always equal total credits; and account types, which classify and record transactions accurately into assets, liabilities, equity, revenue, and expenses. In accounting, there are five main types of accounts: asset accounts, which represent resources owned by the business; liability accounts, which reflect obligations or debts owed by the business; equity accounts, which represent the owner's interest in the business; revenue accounts, which reflect income earned from business activities; and expense accounts, which represent costs incurred in the process of earning revenue.